One of the most important accounting principles is the double entry principle. According to the double entry principle, every debit entry that you have in your general ledger, every debit entry must have a corresponding credit entry. Right? So whenever you're recording financial information in the general ledger, there must always be two legs. There's a debit entry and then there's a credit entry. So your debit, right, is represented by DR, and then your credit is represented by CR. Now on your ledger account, which is in the form of a T account, the debit side is on the left side of the T account, and then the credit side is on the right side of your T account. So what we are saying is that there is no accounting entry that must have a single leg. All accounting entries must have a double entry. In other words, there must be a debit and a credit. Okay, I'm just going to use maybe one example in passing. Let's say the owner contributes capital, and the capital contributed by the owner is 100,000, right? Let's say the owner contributes 100,000. This 100,000 is capital, right? What is double entry? Double entry means that this 100,000, it has to be recorded in two separate accounts in the general ledger. It must be recorded on the debit side in one account and then recorded on the credit side in another account. So in order for you to be able to complete double entry, you must first of all identify which two accounts are affected by this 100,000. So the first account is obviously your capital that I've indicated here, because this money is for capital. But when the capital is received by the business, it goes to the bank. So which means in order for me to complete double entry, I know that this particular transaction on capital must affect the bank and must affect the capital. But in what way? Right? Obviously, the bank is receiving money, which means it has to increase, and then the capital is also receiving money, which means the capital is also going, the capital is increasing. There was no capital, now it's 100,000. There was nothing in the bank, now there's 100,000. So both of them are going to increase. But which one is debited, which one is credited? Now, in order for you to understand that better, you need to go back to the other lesson that I had before on the accounting equation. I'm just going to briefly show you how the accounting equation can help you in completing your double entry. So remember, on the accounting equation, we said A is equal to O plus L. So A, that's your assets. But if you remember very well, your owner's equity was broken down into four things: capital, drawings, income, and expenses. Now, capital increases owner's equity, so it's positive. Drawings reduce owner's equity. Income increase owner's equity. Then expenses reduce owner's equity. So what I've done, I've replaced the O with the four components of the owner's equity, which is your capital, which is positive, drawings negative, income positive, expenses negative, and then my L comes back. And then what you do, you reorganize the equation so that you eliminate the negative signs. So it means A is equal to, A will be, okay, remember when a figure crosses the equal sign, it changes its sign. So in order to eliminate these negative signs, it means the D and the E must cross the equal sign, which means it's going to be A plus D plus E is equal to C plus I plus L. To make it easy, this is what you need to remember for double entry not to cause you a problem. Now, you're going to see that these accounts here, they increase on the debit side and they decrease on the credit side, right? And then these accounts here increase on the credit side and they decrease on the debit side. What am I saying? Assets increase on the debit side, they decrease on the credit side. Drawings increase on the debit side, decrease on the credit side. Expenses increase on the debit side, decrease on the credit side. If you go to your right-hand side of the equation, capital increase on the credit, decrease on the debit, so is income, and so is liabilities. So let's go back to the 100,000 that we're talking about. So if I bring back this 100,000, we've already said step number one is to know the accounts affected. That's your capital and the bank, right? And what's happening? Bank is receiving money and your capital is increasing, so it means it's a plus. But if you go back to this equation that I showed you here, you will see that bank is part of assets, Therefore, it increases on the debit side and decreases on the credit side. Capital is part of the owner's equity. It increases on the credit side. Meaning to say, to complete this transaction, I'm going to debit the bank and then I'm going to credit the capital. Right? So the double entry is completed. I can make maybe one more example because I'm going to use another video to explain this. I can make another example. Let's say you buy a motor vehicle for 250,000. So what has happened is, number one, you need to know which accounts are affected. Number one is going to be vehicles, because you're buying a motor vehicle. Number two, you're going to make use of the bank to do that, because money is going to come out of the bank. So you are gaining a vehicle, which is a plus, and then you are losing money, which is a minus in the bank. So when you do your double entry, you check which side does vehicles increase. A vehicle is an asset, so it's going to be debit vehicles, and then it's going to be credit. You're going to credit the bank, because the bank is losing money, therefore it must decrease. On the previous example, the bank was gaining money, so it was on the debit side, but now the bank is losing money, so the bank has to be on the credit side.